Greetings, welcome back to the August version of Happy Half Hour. That's Toby Weber, I'm Nik Schuurmans. We've got a lot to cover. We've got cost of capital, new Fed chairman getting all sorts of crap for his press conference, which I don't quite understand. We have trillion-dollar companies in July trading like meme stocks. We've got credit spread talk, which many people watch stock prices. Some might say astute investors watch bond prices. So I've got some comments on that. And then just the whole dynamic of the AI spend. I know we talk a lot about AI, but in my opinion, it is the question. And the whole AI trade and complex makes up a huge percentage of what's going on right now.
Do you want to start there? Do you want to start with AI, and where do you want to start?
No, I feel like we always start with AI.
Okay.
So maybe I'll ask you a question. Why did Kevin Warsh, for those that don't know who that is, he's the new Fed chairman. He had his first press conference in July. And people gave him all sorts of crap, and I didn't think it was that bad. Certainly Fed chairs have said all sorts of dumb stuff over the years. If you think about Powell in 2022 said inflation is transitory. So my question is, why is this man in his first press conference getting so much stuff?
Well, I think what he's trying to do is change some of the ways that the Fed operates in terms of how it gives guidance, in terms of how it's structured. So he's trying to make changes to the way things have been done. He's indicated he's very serious on inflation. And so I think there's people, it's a feeling out period. People are just trying to get their head around, who is this guy? How are things going to work now in this new regime? And so maybe that's why they're a little more critical or a little more on top of what he says. What do you think?
I agree with him that the Fed the Fed just talks too much. Like some people say the FMOC, the Federal Open Market Committee, is like the Federal Open Mouth Committee, just because you have so many governors giving their own speeches day to day. Sometimes it can muddle the message. Sometimes they talk markets up, talk markets down. There's some really smart people out there that says the Fed should be abolished and they should let markets set rates. I lean more towards that way, although I think if you completely change overnight, it's going to cause a disruption. I think Warsh is kind of a go-between where he's saying, hey, let's talk less, let's modernize the data points in which we look at, let's use AI, because to be honest, what the Fed does right now is very antiquated. They're looking at reports that are stale, that are a month old, when you have all these market factors, AI moving at the speed of light, and it's just a mismatch, and it's just too much. And I think where he's trying to go makes sense, but it's going to be an adjustment for investors and the press and everyone else to get there.
Yeah, it's interesting. You look coming out of that meeting, what happened? The yield curve steepened, meaning that the longer rates went higher and shorter rates went a little bit lower. So he kind of got what he was looking for, the result he was looking for, even if there was a lot of angst and a lot of hand-wringing to get there. So maybe he's a genius and is just going to let the market do its thing.
Yeah, so time will tell. I think it's a bit too early to pile on. Certainly the Fed chairman is one person. You know, there's all these people that say, oh, you know, the White House is going to make him do this or that. He's one cog in a voting machine. One person can't influence rates. So it's very much committee-based. There has to be a majority. There has to be a consensus. So as much as we like to think that there's other factors at play, there's still a process to making these decisions.
Yep, I agree. So we've seen quite a bit of volatility over the last, call it 6 weeks. Since we last did this podcast, July was kind of a rougher month, and then August has started out on the front foot. August has recovered those losses. What do you take from the market activity over the past 6 weeks? Is it just noise, or is there something going on, beneath the surface?
So from 622 to 729, the period that you're talking about, a lot of the AI favorite name, or the AI darlings, if you will, had severe drawdowns. And I think that's actually a healthy thing for markets. I think in June we talked about all the leverage built up in Korea. We're kind of seeing the same thing here. Margin debt, meaning investors borrowing money to invest, is at absolute highs. It's like 3 times what it was back in the tech bubble. and 5 times what it was before the housing market collapsed. However, when you look at the size of the market, so when you look at margin debt divided by the size of the overall market, it's not flashing yellow yet, but certainly the absolute levels do cause for concern. What am I saying? Are a cause for concern. For concern. But I think these washouts, these drawdowns, these crowded trades that unwind quickly, I think net that's a good thing for investors. It's not good for someone that's chasing performance, but it's good for overall sentiment, just to break check people and remind them, hey, this is a volatile space. The range of outcomes is quite wide. So I think that's healthy, because a lot of investors, as we've talked about, I feel like I'm beating a dead horse, are just crowding into the same names, and they don't know how much risk they're actually taking.
Yeah, we saw semiconductors both here and in South Korea correct pretty sharply over the past month or so, but those are stocks and indices that have gone up 100%, 200% on the year. So a little bit of a healthy correction might not be a bad thing.
Well, investors have a weird way of looking at risk too. Like when markets are humming along, a lot of these large companies are flying high. People perceive that as less risky, which is really the opposite. And then when markets go down by 20, 30%, they're like, hey, so what do we do now? Should I retool my portfolio? It's like, no, that's probably actually a better entry point than chasing some of the best performing names. So it's interesting to see how people perceive risk.
Okay. You got a question there you want to ask? Otherwise, I got another one for you.
What do you make of, and I kind of touched on this, but what do you make when you see a $1 trillion company having these wild swings like they did in July, where you'd see a stock that's worth $1 trillion trading down by 10%, and then the next week it's trading up by 20%, and then the next week it's trading down by 15%?
Yeah, I wouldn't say that it strikes me as healthy, but there's so much money sloshing around, so much money chasing these stocks, people performance chasing, the leverage you talked about. So there's a lot of liquidity that is in the market and moving the market. And so you get, especially around the AI space and semiconductor space, so when you get moves, people moving in, people moving out, you can create some pretty wild swings, which is, again, I don't think healthy, but it seems to be par for the course these days.
Yeah, to me, it just shows how no one knows how this AI endgame is going to finish. Because what volatility is, it's essentially investor expectations about what's happening today. So what's happening today versus a story about tomorrow. And when those two things clash, you get some of these wild swings. And back to my first comment, that just shows you what projections are baked in, which they're quite rosy, and then investors are trying to look at what's going on with earnings and what CEOs and CFOs are saying. And when those two worlds clash, you see some of these wild swings. I don't think I can remember a time in my career where I've seen a $1 trillion company or a company worth $800 billion trading like a meme stock. It's just unprecedented.
Well, SpaceX is a great example. It came out in its IPO a little over a month ago, I think, and quickly went up about 60%, and then quickly retraced lower by 100%. It went from 220 to 110, and now it's gone back up a little bit. So you're just seeing, crazy volatile moves in huge companies, and again, we'll see how that plays out over the long term.
Well, in SpaceX, I know that's a polarizing company just because of the person that runs it, but we had some folks asking about that, and I covered this in my market commentary. I think we talked about it here. Taking SpaceX aside, that's quite a normal glide path for a hot IPO where people crowd in, they exit, then the internal shareholders, their lockups expire, the stock goes down. So as we said back then, if you like an IPO, if you like a private company that's going public, it's usually best just to wait because some of the swings at the start can be quite wild.
I had someone tell me when SpaceX came out and started to move higher, and I was thinking, they asked me what I thought, and I said, we'll wait for it to come back down. And they said, I don't think it's ever going to come back down. So sentiment very strong, very positive, and it did come back down. But, again, kind of a volatile situation.
So when people talk like that, I view that as a sentiment top.
Sure.
Like no smart investor, whether they're the smartest person on earth, they have massive conviction. No one talks like that because markets can quickly humble you.
Sure, and they often do.
Often do.
What are I'm going to put you on the spot because I know you like that. What are your scenarios looking at the rest of this year, heading into 27? Hard to believe we're almost to September. But what are your scenarios for a higher market? And what are your scenarios for a lower market? In other words, what has to go right for the market to move higher? And what maybe has to not go right if we were to see a bit of a correction?
So you're asking me to make my first prediction in the history of my career?
I am. And you'll probably punt, which is fine. But I'm just curious as to kind of get a feel for where are we today?
Well, I'm going to go back to earnings. I mean, we just got through earnings season, and it was pretty robust. I mean, it's pretty amazing some of the profit margins, the earnings growth from year over year, coming off a pretty good year in 2025, coming off another good year in 2024. But it's all underpinned by AI and the capital expenditures. And one thing that I'm paying attention to is, and I'm not going to answer your question, but one thing I'm paying attention to is when you look at earnings in the AI trade, a lot of the chip makers have these massive margins, but it's all underpinned by OpenAI and Anthropic funding that. But
Sure.
It's not coming from revenue that users are paying them. It's coming from raising capital.
Sure.
So as long as these early AI models can continue to borrow and get creative with their financing to fund the massive investment, I think that flows through to a lot of the chip makers and the whole AI complex, the broader economy. As soon as someone says, hey, the math just doesn't add up, I don't think this is ever going to be profitable, I think some of these early models are going to go to zero, or we can't lend them money under these conditions, then I think you start to see some cracks. But right now, and that's why I brought up credit spreads. I'm very closely following some of the massive AI players and spenders and their credit spreads. Most people look at stock prices. I think that's fine. The bond market often sniffs out trouble before most people realize it. And what's currently happening now, and this is not going to surprise you, but credit spreads are drifting higher for some of the Mag 7 names, meaning if they're to raise capital, which a lot of them are now because they can't fund these massive promises from cash flow anymore, they have to go to the debt market. Well, the cost of borrowing is going up. Okay, interest rates are already not historically, but in recent history, higher than they've been. Now they're borrowing above that rate, and investors are demanding more in interest to loan them money. So that'll be interesting to play out because as the cost of capital goes up, as these checks that they have promised to write get bigger and bigger, that could be the domino that falls that maybe unwinds some of this.
Yeah, because OpenAI and Anthropic are trying to go public, and the reason they're trying to go public is that they need capital.
That's right.
And they need to keep feeding the beast, feeding the machine. And the question is there enough cash flow generation from the business to support if they have to borrow or support what they have going on? And I think that could be, you and I think what you're saying is we're looking for signals or monitoring things to see when things might start to not unwind, but just change. And I think you're looking at credit spreads. We're looking at the revenue and the pricing on some of these models that are out there, and just looking for signals that something is different. Either a funding doesn't happen, a CDS spread blows out, something gets canceled, they aren't able to go public. Something like that could be a trigger for the AI trade or the AI narrative to deflate a bit. And again, not necessarily crash, but deflate a bit. And that's really what's been driving earnings and really what's been driving our market for the last couple of years, really.
Yeah, and I sound like a broken record, but I think it's important to understand what our job is and what our role is. We manage most most of our clients are folks that are retired. And most retirees shouldn't be in the business of making massive active bets on a risky theme, on a capital expenditure investment cycle that we haven't seen the sheer volume of in our lifetime. I mean, this trumps every single capital expenditure cycle in market history.
Right.
And it's not even close.
Right.
And I'm not saying that this one is different or not different, but when you look at the rhythm of every capital expenditure cycle where companies are making massive investments in infrastructure, there's usually a bust cycle. We've experienced the boom cycle. We haven't experienced a bust cycle. And I don't mean to sound like a broken record. I don't mean to repeat myself. But this is a big deal. And I think, again, we want to own the AI names and the AI complex. We just want to be mindful of how we're exposed because, if it does unwind, it's not going to be a friendly, subtle unwind. It's going to be quite violent, which is why we own bonds, which is why we own gold, which is why we own other equity asset classes that aren't tied to the AI trade. I think tangible assets make a lot of sense in this environment. I think real estate can make some sense in this environment. So we've talked about a lot of this stuff, but the human mind sometimes needs to hear things about 10 times before it clicks. And then, it's like the warning, the boy who cried wolf. People don't really, it doesn't flip until something actually happens. We're just trying to get in front of it a little bit.
Yeah, and I think we want to have exposure to the areas of the market that are doing well, but we just don't want to be overexposed to those areas because, as you said, that typically when there's a boom, it's followed by a bust. And that bust could be 2 years, 3 years, 5 years from now, but it also could be later this year. So we just don't know. So we just have to be, smart about how we manage that for clients because, quite frankly, they don't wish to and don't need to take the risk.
Well, and there's certain signs. I'm big on what humans are saying in sentiment and all that. I had a prospective client tell me, and this guy was like in his early 70s, tell me, I basically expect 15% a year. I can't do 7-8% a year. I think 15% a year. And I just look at him, I'm like, well, this is probably not the right fit for you. This is not a hedge fund.
But if you look at the last 3-4 years or even a little bit longer, it's understandable why people would expect that because that's what we've seen. But what you and I have to keep coming back to is that that's not typical. We mentioned before that in terms of a 4-year cycle, we're in the top 1% for the last 4 years over the last 100. I didn't say that very well, but the point being that we are as elevated in terms of a 4-year run here as we've seen over the last 100 years. Could it continue? Sure. We hope it does, but we just want to be prepared in the event that it doesn't.
Well, and if you look at history, and of course we're big fans of history. I write a lot through the historical lens. If you look at history, 60% of the time the market goes up. It's like 65% of the time the market goes up. Okay? I'd say 20% of the time the market goes down, 25% of the time the market goes down, and then 10 to 15% of the time it gets really weird. And periods that seem easy, where investing seems easy, when people are bragging on social media about their 401k balances or what stocks they bought, that's often what precedes the difficult period. And what derails us, like Toby asked me a question, like, what's your opinion on the second half of the year? What could go wrong? I talked about the financing thing. It's usually something no one is talking about.
Sure.
Think COVID. Think geopolitical conflict. Think just randomness. So a lot of people have their crystal balls out and are trying to project what happens next and what could derail the market. It's something no one is talking about today. True risk is what is left over after you thought of everything.
Good. Do you have another question for me? Otherwise, I got a couple of softballs for you.
Go for it.
What do you make of the Blazers and the Moda funding? Is that something you don't even think about, or you think it'll figure out its way out and get done? Or what are your thoughts on how that's playing out?
I've loosely tracked that. What I will say is, I have to be careful. This feels, again, like entrapment. It would be an absolute travesty if Portland lost the Blazers. I've been going to Blazer games since I was a young boy. My dad took me. Used to listen to games on the radio with Bill Schonley. We've had season tickets for the past 4 or 5 years. I think the team's starting to get decent. They made the playoffs for the first time in, 4 or 5 years last year.
Yep.
Got some good young talent. Portland needs positive things, and in my opinion, the Blazers are a positive thing. It brings people together. They have a long history in this city. It would be a travesty if we let politics get in the way of the Blazers staying in Portland.
I think that's well said, and I don't think it will, but it's certainly been a little bit eye-opening over the past couple of months as this plays out, and the threat that the Blazers could go elsewhere if we can't strike a deal to keep them in Portland. So we'll see how that plays out this week. Last question I had for you. Any comments? Do you want to introduce the new website that came out this week, end of last week?
Yeah, so for those that don't know, Waverly, most of our clients have probably seen it, but we do have a new website, and I think they did a good job. It reflects more of the ethos, the culture of the company. It's more modern. It's optimized for search. Of course, we're big on content and digital marketing. We don't have salespeople here. Our content is our sales force that helps. The new website helps people find us. So I think folks will enjoy it. We're still kicking the tires. We're still giving feedback, but it's a step in the right direction. So if any prospective clients have feedback on the new site, feel free to shoot us a note because we're open and we'll pass that along to marketing.
No, we're excited. The marketing folks at Waverly have spent a tremendous amount of time and energy and money to redo the website. They sought input from all the different offices, and we were maybe not in the front of that line, but we were certainly providing our input because we wanted to demonstrate the breadth and scope of Waverly, but also, have a local flavor to it as well. When we talk to people in the local market, Lake Oswego, Portland, Vancouver, Camas, we want them to be able to see the folks that they're going to be working with on a local website. So we're excited about the changes that have been rolled out and look to continue to make that an emphasis.
Great, so we're rolling up on 30 minutes. This is the August version. It's summer. We hope you get outside. We hope you enjoy the sunshine. Great time to be in the Northwest. If you have any questions or feedback or want to know how we work with clients, you can respond to the Sunday Coffee Reads email that you got. That's how you're viewing this. And we wish you all the best. That's Toby Weber, Nik Schuurmans. We'll see you next month.
Cheers.